Good evening. I'm delighted to open the 15th Sir Gordon Wu Forum on Chinese Economy and Business, and to welcome our keynote speaker tonight, Mr. Charles Li. My name is Xiangjin Wei. I'm a professor at Columbia Business School and director of the Chazen Institute of International Business. Sir Gordon Wu has been actively involved in East Asia's rapid economic rise and is being a major force in infrastructure sector. The Chazen Institute hosts a forum on Chinese economy and business in his name twice a year. Columbia Business School and the Chazen Institute engage in many China-related initiatives. For example, I myself take over 100 EMBA and MBA students to China every year, because different parts of the school and different parts of the campus have many more other programs actively engaged with China. We also host various events like this, either on campus or elsewhere in New York City. For example, we have an annual university-wide NT1 lecture series on Chinese economy. Our most recent speaker in that series was Professor Zhou Qiren, a very well-known economist from China. At the Columbia Business School, we are very fortunate to also have Luru Chao Wang Senior Visiting Scholar Program, and I stand our current scholar. Our current scholar, Dr. Ba Su Song, will be with us tonight. I haven't seen him yet, but I think he will come. We support, the Chazen Institute supports many other China-related initiatives. For example, we will soon be sponsoring the Greater China Society's 7th Annual China Business Conference, which will explore the theme of the search for the next growth frontier. They will take place on Friday, April 25th. We are very honored to have Mr. Charles Li as our featured speaker this evening. Mr. Li is the Chief Executive of Hong Kong Exchanges and Clearing Limited. Mr. Li has over 20 years of experience in the financial sector. He has been a lawyer, has been an investment banker, has done many other jobs. In addition to all of those, listen to this. He was an offshore oil worker. Before he went to college. He received his college degree from Xiamen University. And then he was a reporter, a journalist for a few years before he come to the US for his master's degree from University of Alabama. And he received his JD degree from Columbia Law School in 1991. So how often do you run into a speaker who has been an oil worker, a reporter, a very successful lawyer, a very successful investment banker? So before his current job, for example, he was chairman of J.P. Morgan Chase China, and before that, he was president of Merrill Lynch China. So please join me in welcoming our speaker tonight. The format of tonight's forum is this. So I'm going to start with a conversation with Mr. Li, and then we'll open up for questions. Okay? I'd like to start my first question about Hong Kong versus Shanghai. As you know, you are heading the major stock exchange in Hong Kong. Mainland China is also very actively developing Shanghai as a potential international financial center. Given that, does that represent competition or opportunities or some combination with that for Hong Kong?
Well, some combination of that, and that would be the short answer. And well, I get asked this question quite a bit, and let me find a better way, because there's a lot of people, I'm sure people have a lot of other questions. Yes, it's competition, it's a partnership, it's everything. But essentially, we look at the uniqueness of Hong Kong. The Hong Kong is unique in the sense that we are not an onshore exchange, and we are not an offshore exchange precisely either. And it is really the one country, two system in Hong Kong that make Hong Kong extraordinarily unique, that we are able to play a particular role in China's transformation in a way that is very, very hard for either onshore city or onshore financial center to replicate or replace. And also equally, it's equally hard for anybody else outside China, international exchange, to necessarily replace it. Essentially, it is one country, two system, meaning that you have one country means the Chinese, whether it's the government or whether it is the corporate or anybody else that wanted to access international capital, access international market, feel more comfortable at home. And Hong Kong gave them a sense of home, even though it's not entirely the same. At the same time, because it's a two system, it's not another city. It's not Shenzhen, it's not Shanghai. And international investors, international market trust the rule of law in Hong Kong. It's free. It's completely capitalist market economy. And it's probably the freest economy in the world today. So as a result, the essential future is China meet the world and the world meet China. And in that, Hong Kong is the only place where both can find something common that they can actually trust and feel comfortable to operate. And yes, maybe one day China will become completely international, and maybe by that time there is not a need for this sort of a middle ground and gateway. We don't know when that's going to be. That's going to be 10 years, 20 years, 30 years, but always so the issue is not whether or not Hong Kong is unique and other Shanghai or other places may one day become as competitive. The issue is how do we position Hong Kong? We need to position Hong Kong in a dynamic manner rather than, if we only think in Hong Kong we are the net beneficiary of China's arbitrary and artificial barrier, and we're trying to be the narrow beneficiary of that, and then you obviously always want to celebrate the barrier. But we actually wanted the barrier to come down because, if you are the beneficiary of the barrier per se, then you worry about the barrier coming down, and that's not really what we are. What we are is that we want the barrier to be down. We only want it to be what China ultimately needs. If you think China is a ball, and that ball is explosively growing, Hong Kong's right position should always be on the edge of that ball. And it's always about breaking into the next thing that China cannot do without Hong Kong, and Hong Kong can enable China to do. But as soon as that mission is finished, you wanted to give the people in China, give our counterparts and partners in China the confidence that as soon as it's something they can do, they are able to do it themselves. And you move on to do the next thing that they cannot do alone, and you can help. What we can't do is to always, put ourselves in this position to think, we want 特殊政策, beneficiary policies and 优惠 and all of this, ultimately to entrench it. Then you start to see people in Shanghai, Shenzhen, other people say, why do I support Hong Kong? If I support Hong Kong, the ultimate outcome is Hong Kong becoming a competitive place where you entirely take my future away. Why do I want to mortgage my future away to you? So you need to take that question off the table. You needed to basically present them to a position to say that anything you are able to do with me today, I'm the only partner who can help you achieve it. But as soon as this is something that you can do without me, I want to return that to you. And then you can feel free to give me the next thing that you can't do without me. So Hong Kong is always going to be on that edge, exploding, helping China to explode into the outside world. If we're able to be comfortably continue to be on the edge, rather than constantly trying to hold on to what you got yesterday, that's how we can grow, and that's how you can make people in China completely trusting that you're the partner who's going to take them. Obviously, every time you move on, you give it to them. You can say, can I be a minority partner? Can I take something out of it? So that you can grow with them, but you don't have to take their future away. So
this is an excellent point. Let me pick up on this. On the point of growing with China, right now in Beijing, the Chinese government has just concluded its People's Congress conference, laying out the reform plan for the coming year and last November, the plenary session lay out an ambitious plan for the next 10 years. When you look at those plans, are there particular elements in those Chinese government announcements or blueprints that you think Hong Kong can play a especially important role?
Well, the more open China is, the better off for Hong Kong. And, I don't look at the various policies in its granular detail. I look at, the holistic, the program and the direction of the program. And in that direction, I see tremendous amount of opportunities that we can take advantage of. Take that into Hong Kong Exchange business itself. We historically is equity-driven exchange. We're now massively moving fast into fixed income and currency and commodities because we believe that's horizontal asset class, full dimension, allow us to really serve China and help China achieve what many of the things that it has hard time to achieve. I can go into granular as to what we do on each one of them if people wanted to. Just very quickly, I think if you look at China the last 20 years, China and Hong Kong essentially the last 20 years success started in '93 with the first listing of 8 shares and the Qingdao beer. And that essentially started, Hong Kong before that was a regional market with 3 trillion Hong Kong dollar market cap of all the company listed. Today it's 23 trillion. 60%, 55% of the market cap is China-related companies. Close to 70% of the average daily trading is from China-related companies. So clearly, that transformed Hong Kong. And if you look at the story, Hong Kong essentially in China's reform over the last 3 decades, 2 decades, 2 and 3 decades, there are really 3 big events that happened. One is trade, foreign trade. And that created China's first bucket of gold. And second big event of the last 30 years of reform is FDI. FDI essentially converted China into the factory of the world. And the third big event is the capital market in Hong Kong and helping China to basically develop its capital market and allowing China's massive amount of companies to raise capital and become an international company. And today, now, because of the capital market achievement, China's banks are now the world's largest banks per market cap. China's insurance companies are the world's largest insurance companies in the world. China's telecom companies are, by market cap, the largest company. So clearly, that has transformed. But all the 3 key events, trade, FDI, and capital market, has one thing in common, that is money flowing into China. And so China's story the last 20, 30 years is the accumulation of wealth and is the import of capital for that 20, 30 years, and Hong Kong thrived on that success. I think we start to see a major shift, and it's an assessment shift of China. That is really China is done with capital appreciation and capital accumulation. China has too much money rather than too little money. The issue is how to preserve the value of the money China already has. In fact, the biggest challenge, you can have 7% growth, but if you're going to lose 10% of your accumulated wealth over so many years simply because the US dollar is depreciating, something else happened, you're holding everybody else's backs. If somebody else has a problem, the US Federal, why the US is so strong, the Fed's monetary policy, the rest of the world, pays half of the ticket. So they can do whatever they wanted. At the end of the day, everybody else here underwrite entire problems of the United States together with the U.S. taxpayers. So that is China now need to make sure the next century, the next 5 years, I think we have started to shift to see China will become the exporter of capital. China has too much capital rather than too little. How Hong Kong change in that big change is the big subject.
If I could follow up the last point you made.
Could I get some water somewhere? I know Colombia is cutting costs. I know.
Our strategy is to keep our speaker thirsty. It should be coming. Yeah. Since you mentioned U.S., China, and Hong Kong in your last answer, let me ask you the following. U.S. Very likely in the next, within the next year, U.S. monetary policy is going to unwind its massive balance sheet position. Both China and Hong Kong are very strongly connected with U.S. economy through trade and through financial linkages. China's trade connection with the U.S. is very, very strong. Hong Kong, of course, is also has its currency permanently pegged to, thank you very much, pegged to U.S. dollar. When U.S. starts to unwind its monetary policy, history suggests that you would tend to see massive change, in global capital flows, a lot of movement in interest rate, and so on. What kind of opportunities or challenges would this present to Hong Kong, a very open financial center with a pegged exchange rate, and what kind of opportunities and challenges would this present to China, which strong connection in trade with the U.S., somewhat inflexible exchange rate, and I'm very interested in your thought on this.
Well, I'm not an economist, and I tend not to attempt to explain issues in a way that make me sound smarter than I am. And so I generally deflect that question, reflecting the lack of education and training as an economist. But on the other hand, I read all the economic reports and all the research analysis. I really couldn't get my arms around what people are saying. So I don't really know. I don't know what the Fed tapering is going to do, whether the acceleration or the deceleration of that tapering is going to do. And there are all sorts of things. I'm trying to stay at the philosophical level. First of all, at the exchange level, I don't really care that much because that doesn't, I don't have my capital at risk. I don't worry about, I run a market. As long as people are trading, I'm making money. And whether people are losing money while trading or making money while trading, I'm generally speaking, I'm not indifferent because I want people to make money, but you can't really keep on doing it. So I just worry about the trade flows. But Hong Kong is the unique place where, it's a kind of a very, I don't think there is anything else like that in the world. You have an economy that is fundamentally tied up with China underlying economy. Essentially, then there's no real economy in Hong Kong other than what is really evolved with China. So its economic cycles goes in sync with China. On the other hand, its monetary policy is completely tied up, through the peg with the Fed. So as a result, Hong Kong is constantly have to deal with this, split personality, and some of the times, both engines are working in the same direction, and Hong Kong is going through crazy times. The Chinese is growing, China economy is growing, the Fed policy is supportive of that. Sometimes, one is working, the other is working the other direction, so you ended up really getting torn. Sometimes, and you hope fewer and fewer times, they're both not working against you. And I think right now, it's a little bit of that. The underlying economics of China is going through restructuring, going through some uncertain times, and people worry about whether the slowdown is going to be meaningful. On the other hand, the Fed policy is really, the reverse of that easy money is creating a lot of fund flows that are, making emerging market trading very, very difficult. But Hong Kong is so free, it's used to this sort of a massive flow, and it find a way to deal with it. And I'm not terribly worried about it, not only because I don't understand that much, but more importantly, there's not a whole lot I can do about it. So my philosophy is when I can't make a difference, I don't worry about it.
Okay, very good. Let's open up for questions. Are there microphones? Microphones. Okay, so please raise your hand, and when I come to you, when microphone comes to you, please state your name and state a brief question. Savio, please. Yes. Yeah. Jennifer?
Savio looks as young as ever.
Thank you. Well, welcome, Charles. Savio Tung, a former trustee of Columbia University, and I'm working for InvestCorp. Professor Wei, I think we missed one small introduction. Charles is also our current trustee. He's doing a great job.
That's right.
He comes all the way from Hong Kong 4 times a year, and we have to thank him for his dedication. So
thank you.
Thank you. A question that I have is about the Hong Kong Stock Exchange, your umbrella. I read recently that of 100 IPO applications, you turned down 30. Now, that's a very big selectivity. In the US, it's a lot lower than 30% rejection rate. Is that a reflection of the quality of the underwriters, or is this a reflection of your processing? That just explain a little bit of your criteria for the listing in Hong Kong.
Yeah, great question, and you're very perceptive. And this is actually a complete anomaly, because what happened is, we don't have that sort of rejection rate at all. And also, in the past, there was no such thing as a rejection. Most of the time, if you get rejected, you never really go to the listing hearing, so you never really see yourself rejected. Nobody liked to be rejected. So things would, almost all the companies that are going through the listing hearing, the listing division initially work with you, and then the listing committee hears it, approve it. Seldom they reject it. If they reject it, it's already happened early. What happened is that we're going through a transition between a new reform called a listing regime change. We are now adopting, starting from end of March, starting April 1st. It's a complete new regime started kicking in. The new regime essentially trying to do 2 things. One, we want to really improve the quality of the submissions, the applications. Unlike in the US, when you file with the SEC, the prospectus is substantially complete, and then the SEC work with you. You can't really just give them some sort of early draft and hopefully eventually you work out into something. So you're pretty much 90% done, and whatever is not there is because the new questions generated. Our old rules historically has been pretty much, we're very relaxed, allowing people to submit the stuff. The listing division work rounds and rounds of drafting comments with them, eventually generating into something that is good enough to be submitted. We have been criticized on time for a couple of things. One, it takes quite long for that cycle to work, number one. Number two, there are a lot of questions people keep asking to the professionals, so they just feel that in the US it's very easy, 50 questions the first round, immediately 15 questions the next round, and last time 1 question is done. Here it just goes around and around, and also takes much longer. So we are now committing to the market that once we receive a draft, we are going to be very quickly going back. 7 days we're going to give you this, 10 days we're going to give this, 15 days we're going to give this. So it's going to be a very disciplined process. In exchange, we demand the market submit us a substantially completed prospectus. And now under the new regime, for all 3 days after we receive your submission, we look at very quickly, see whether you fundamentally missed something. And if not, we put you up in the public, put it on the website, and people actually can see your prospectus. So that provides a huge incentive for the professionals to make sure whatever you submitted is going to work. Because everybody's going to say, oh, what? This is the sort of lousy prospectus. So a lot of people are now racing against the clock to trying to submit it before that deadline starts to come in and the new regime start to work. And now we are also looking, actually it's March. So we already started that. And then this rejection is more about the 3 days, the 30% is the 3 days we find out, oh, you're missing this, you're missing that, you're missing that. In order to really encourage people to be disciplined about this, because as soon as the clock kicks, we are committed to come back to you. So therefore, the 30% rejection is more about they're not complete. They need to go back and actually, however, there's a penalty. If you submit it without, complying with the initial, requirement, you're back on the queue. You have to spend, back on the queue. So I think that's what you're reading. So in the end, these people can all come back. Yeah. We don't have that issue. Generally speaking, the Hong Kong Stock Exchange, like the SEC, we're all disclosure-based. Usually all the questions about disclose, rather than in the mainland. It's more of a substantive. If I don't like the company, or if we generally speaking this month, we rather have very few companies, then we just find problems with you. Or we actually don't even bother to tell you why you're not we just leave you there. And that's why they're changing. There are 700 IPOs waiting in the Asia market. Yeah. Okay. Just wait for a second. I think the first hand was there in the middle. No, you give it to him first. But I think there was a hand,
Hey, Charles. Good to see you again.
Thank you.
Daryl Yap from Bregal Investments. Charles, what's your view on the outlook of the exchange receptivity towards Class A and Class B structures?
You want to ask me about Alibaba, right? I mean, there is some sort of a media report here, or ultimately it's going to be on the web, and I'm assuming some of you are going to put on your Weibo and Weixin. So I'm going to have to watch my word a little bit more carefully. This is I don't know how much you follow this. This is obviously a quite an interesting thing. It's a great company. A few great companies in that space wanted to, list, and because right now there's a divide between the regime in China and Hong Kong and the regime in the U.S. In China and Hong Kong is largely, there's very little differentiation between the rights of a shareholder, whether whatever it is. There's very little distinction. One share, one vote. Everybody's the same. Where in the U.S. you have AB shares. So philosophically, a lot of people in Hong Kong felt that why do we have to change? And then other people are saying, well, we probably need to be more competitive. And if the U.S. has it, the U.S. is not necessarily Kazakhstan, Afghanistan. It's a pretty established market. Why they have it? What's the philosophical underpinning of that regulatory regime that allows it, and why we are not? Whether or not the fact that we don't have it indicating we are more advanced, we're more morally pure, or we are less innovative. So there's a big philosophical debate in there. I think it boils down to two fundamental philosophical approach to issues. One is about fairness. Everybody put into the money into a company should have the equal right. Nobody else should have a special right over the others, because whatever is the reason that is driving the rationale of providing a particular class of people more rights than others, that rationale may not be perpetual. That rationale could disappear, and it could lead to abuse. Vis-a-vis the other philosophical extreme in the U.S. that let's just, as long as we disclose it, let the investor deal with it. Investor know if it's a different class, if it's a different right, they will price it accordingly, and the market will deal with it. So between these two extremes and where Hong Kong is going to fit into, then you have a lot of people, debating. And Hong Kong is a politically today a pretty sensitive place. There are a lot of sensitive feelings about things, and very few people necessarily wants to pick up a controversy. I have a thick skin, and I usually don't. I'm not afraid of controversy, so I sort of wanted to have a debate. And at the same time, you can't have a debate of having a particular voice, and because you speak from a position of institutional importance, and also at the end of the day, this is a Hong Kong Inc. Decision whether we are philosophically going to be here or whether going to be here, and some people in the middle are two camps. One camp is going to say, well, philosophically we should be here, but on the other hand, we should also recognize the reason the U.S. allows this. One of the key reasons is that they're not afraid of abuse, because the private enforcement in the U.S., the class actions in the U.S., the institutional investor sophistication in the U.S. are such that allows enough counterbalance to this particular structure. So in the U.S., focus on disclosure. Investor can take care of themselves. Investor have enough weapons at their disposal to deal with it should abuse arise. Vis-a-vis another group in the middle, the moderate, not extreme purist, but the moderate is also saying, well, Hong Kong, we don't have it, but if we have to have any change, We may not necessarily be there, but maybe somewhere in between. But whatever we do in Hong Kong, we have to reflect our tradition of rule of law. We have to have a due process. We have to have a great consultation so all people speak and to be able to come up to a solution that fits Hong Kong. So we are in the process of that. But that process, democracy, take time, and debate take time, consultation take time. We may not get there. And so in the end, it's going to be whether Hong Kong is going to get there, and if it's not going to be there, whether somewhere in between, or we're not going to move in the end. And then other companies will have to make the choices, because the choices of coming to the U.S. with that protection is great, but coming to U.S. has a lot of other issues that you also need to deal with, because you may be getting more protection from a governance standards perspective, but you may be also be more vulnerable because of the class actions and other issues in the U.S. So whether or not, a small shield, a weaker shield in Hong Kong works for you because the investors have less weapon, vis-a-vis a very strong shield in the U.S. that make you feel good, but the investor have machine guns that can shoot through the shield. Which one is better? So Hong Kong need to make a choice. Issuers need to make a choice. And the rest remain to be seen.
So mechanically, what does it take for HKSC to allow for a dual share classes? You can make the decisions, or does it take an act of a logical?
No, it's not a legislative decision, which obviously will make things a lot more difficult than it is. It is about amending the listing rules of the Hong Kong Stock Exchange. But in order for us to do that, you need to have a broad-based consultation led by the listing committee of the exchange and ultimately sanctioned by the SFC.
Okay.
Not going to be easy.
There was a hand somewhere down there. Yes.
大家好，我叫 Alexandra Tirado。李先生，非常感谢你今天给我们演讲。
Wow, good. Thank you.
My question is let me remember my question.
You remember the Chinese, you forgot the question.
So Sarbanes-Oxley law is putting tremendous pressure on Chinese companies that are listed in the U.S., so much so that the SEC and PCAOB are threatening to ban the Big Four auditors. What is the probability that Chinese-listed companies in the U.S. will delist and try to go on the Hong Kong exchange? And also, Hong Kong is strengthening its own securities and regulatory laws. Are you willing to absorb these companies that aren't transparent?
Okay, well, your last question was framed in such a way that is almost the answer is automatically, of course not. But the issue is more complex, and you need to look at the nature of the companies that caused the problem. When I was confronted by Bloomberg and Wall Street Journal, and this is like almost a year or two ago, I thought it was a good interview, and I started. Then the first question I ask is that we have in the U.S. all these problem China companies that are causing uproar in the investor community. If in the U.S. there's this bad, there must be so much worse at the Hong Kong Stock Exchange, right? And the complete opposite is true. Because the companies that are causing problems, about 400 companies that reverse takeovers, many of them are the root of the issues here. Those companies don't even see the light of day in Hong Kong. They couldn't even stand in the queue because they would be disqualified a long time ago. But the precise reason they're here is because actually in the pink sheet, in the NASDAQ reverse takeover part of the regime, it's so easy for them to be here. They're not really listed through the normal procedures of disclosure, SEC registration. They bought a company that is a pink sheet traded, then they inject the assets into it. So they never really went through the listing processes. And those companies have no hope of getting listed in Hong Kong because not only because the professionals there, it take a couple of phone calls to figure out some of the scheme just so easy to see through. But if you go down to Florida retirement community to trying to sell a China story, of course the people down there are going to have a harder time to figure out. And if the young guy looks very handsome and smart, And in China, wow, great, okay, here's the $100,000. And, so in Hong Kong, but that's really the reality. It's a bunch of companies here that really should never really be in the capital market, in the open market, but they're here. And the U.S. obviously now recognizes that's the issue and is trying to enforce that. And now the auditors are caught in between. And I think then the regulators start to really have a big issues. But that also reflects the philosophical different approaches the U.S. regulators and China regulators have. Because, the U.S. regulators are saying, this is from you, China. They're doing bad things in the U.S. market. And you need to really, they're not even saying you need to help me to solve the problem. If they use the word help, probably the Chinese would be responding a little bit more favorably. They said, fix it. And then the Chinese are saying, sovereignty. You can't tell me what to do. And by the way, remember a few years ago, I went to you and I said, there are all these companies listing in the U.S. You need to get my approval in order for them to list. Okay, can we work out a memorandum? And you told me to go home because you're a free market. Anybody can go. Why we allow the Chinese government to be a gatekeeper of all those companies? They're free to come. We're a free market. Now the free market, you have a problem. Now you come to me. Thank you very much. So you have the two regulators start to philosophically have a very, very different approach. Hong Kong have similar issues. We have a couple of companies have similar issues. You resolve it by talking. You resolve by saying, I can help you. You can help me. So it's, there are politics involved. There are also China itself. You have the state secret laws, which is there, never really meant to be applied to auditing papers of some company that nobody even know what sort of state secret is. But the problem is the law is there. And we all know a lot of people from China here. For the CSRC, for a lot of regulators to deal with the State Secret Bureau, this is not something they want to do every other day. And, so they'd rather this issue go away probably if I were them. So we're going to get stuck there for a while. But ultimately, in the end, that companies get delisted, and they're not going to be able to come to Hong Kong. And there might be a few good companies that got delisted. I seriously doubt a good company will be delisted by this. But some good companies may decide for a lot of variety of other reasons to say, I'd rather just go back home, because investors there know me better. The listing is not only a capital raising, but also a branding exercise, a marketing exercise. So a lot of other reasons. So we will see some companies move there, but I wouldn't really characterize that as because the U.S. is too strict and they're too bad, and therefore they're coming to Hong Kong. I don't think that's the case. In fact, I would argue on the whole, the company listed in the Hong Kong Stock Exchange are much, much better than the Chinese company listed here. Well, that's an easy statement because 400 of them are reverse takeovers. Okay? All right. Gentlemen.
Hello, my name is Shahar Gonan. You made an interesting comment about the challenge of preserving wealth over time, and in that vein, was wondering if you could share some of your thoughts on the developments of the gold market and commodities broadly.
Yeah.
Thank you.
I think the gold market and silver market, they're probably more of a proxy of money, and the Chinese investors generally like them. And has very little necessarily to do with the commodity cycles and all of that. So I would put them into a separate category. On both commodities, China, has been growing so fast. It was really the single most important driver for the commodity boom of the last decade. And the people are saying that boom is over, is finishing. I think it is taping off. I don't think it's over. Whether or not we can have that kind of massive boom is still unknown. But you just basically just think about it on the commodity cycle. You have many of the commodities, the supply are still dwindling. They've become fewer, harder to explore. Environmental standards are moving up. Community activism are going up. So it's making it more and more difficult to get more commodities out of the ground. It's only going to become tougher and harder for them to come. Meanwhile, you still have China and Africa, India. You still have over a couple billion people in China is a great example of it, that are urbanizing. When you have that sort of urbanization going in such a short period of time, in such an organized manner, the need for bulk commodities it's just no way, that is going to work away. But China's issue, the reason why we jump into it, not because because we are not trading it, we're not buying, so we don't care whether it's a boom or it's a bust. Well, we do care it's a boom, and sometimes a bust, not all the way bust, and then everything reset to zero. Obviously, that doesn't work. But generally speaking, the up and downs of the market is not what we care. But the issue for China is that you are the biggest volume taker of bulk commodities globally over the last 10, 15 years, will continue to be the volume taker for many years to come, but you're also the price taker. If you're the real volume taker, you should be the price maker. It's pretty simple with that. But China itself, trying to isolate itself, trying to protect its domestic market. So as a result, the real economy of China is taking so much commodity from the rest of the world, but at the mercy of international price. The domestic players are not able to hedge effectively because China just controls the flow of capital. So we see a huge opportunity for us that when China's renminbi is internationalizing, the capital account is opening, and the need to risk management, the commodity volatilities is such that you have to have China's price benchmarks internationalizing, or for China to be able to play a much more active role internationally in pricing commodities. So it is that massive trend that essentially was the driver for us to take over London Metal Exchange. When I started, on the first 2 months of my term at the Hong Kong Exchange, I called up Morgan Stanley at the time, who were sort of close to London Metal Exchange. I said, do you think they would be interested in any discussion? The answer is, they checked around, the answer is London Metal Exchange is never up for sale. It's owned by the members, it's a great club, there's no need for sale. So therefore, we sit on it, we watched it, and until one day, they decided to sell. As soon as they decide to sell, we jump in and we take over. The rest is history. So that's our first leg of getting into the commodity, because in Hong Kong, there's no commodity history. There's no tradition of doing commodities. And in order for us to present us as a value proposition to China Inc., we need to be a commodity giant. We were not before LME. Today, we are in base metals, but we are still not in iron ore, coking coal, energy, agriculture. And I think we are now using LME as the catalyst for us to build a Hong Kong-based commodity platform so that we can begin to offer initially product, and then liquidity, and ultimately market mutual access, so that Hong Kong can become a place where international producers are able to find a way to. Because today, iron ore, for example, the producers think this is the price, the consumers think that's the price. They can never agree. So if you have a platform that is controlled by the producer, the Chinese will never trust it and will never play with it. But if you have a platform that is controlled by China, the producers will never ever participate. In Hong Kong, we're hoping that beyond base metals, we're able to play a neutral place and platform where we can find a place where liquidity can converge in Hong Kong and price can converge in Hong Kong, and Hong Kong can actually become an Asian time zone CME, over time.
Vera?
How do you expect the consolidation of the exchanges to impact you in the future, specifically, and the industry in general?
I think the exchange industry, and the equity exchange industry, generally speaking, are local industries and local businesses, particularly if in a country it's all sovereign politics. So I think the traditional equity exchanges across the border international exchanges probably very, very difficult to realize. I mean, Singapore was very close taking over Australia, ultimately, failed in front of nationalism. And I think that's going to be true everywhere else. But many of the advanced economies exchanges like NYSE and NASDAQ and all of them, they are much more driven by cost, and by rationalization, because the market becoming so fragmented. But I think the boom, the sort of a big M&As in this exchange space is probably over, because the driver is just not there. Equity, again, across border doesn't make any sense anymore. Some of the big exchange merger, the ICE takeover of NYSE, is more about ICE trying to move into Europe. It's more about the Life acquisition. I think if Life is not part of NYSE Euronext, it's arguable whether ICE would have taken that transaction. So it's more about horizontal asset class build out. Hong Kong Exchange take over LME, moving from commodities. ICE taking over all geographical expansion, all asset class expansion. Life is more of a financial derivative, and interest rate and everything else. And ICE used to be more credit default and credit and derivatives. So I think we can see some of that, but generally speaking, I think that game is probably over. Yeah. And we are certainly not interested. We are the largest cap stock exchange in the world, $23 billion market cap. We're traded at 25 to 30 times PE. So all the bankers constantly come. You can issue stocks, you can buy this, and it will be EPS accretive. We're not interested.
Okay, we have last two questions. You first, and then Legend.
Thank you. Angie Tang from Committee of 100. Welcome, Mr. Lee. You have been known as a reformer. So in addition to acquiring the all-important London Metal Exchange, you've also extended trading hours. You've, as you said, increased market cap to the largest now, increased profits for the exchanges. What do you consider your biggest achievement in your less than 5 years you arrived in Hong Kong?
Well, that's like saying something that I'm almost going to get fired, or I'm going to resign, or I retire. I haven't really stopped taking any stocks yet. But if you say what are the things that I find the most interesting and rewarding doing this, and also why, it's really, we are potentially in the middle of making history. We are trying to create something, and China is transforming structurally. And how can we help that, at the same time structurally put Hong Kong into that train that is forever going to be structurally part of it? And there are a lot of changes. I think probably my unique background helps. I know China a lot better than most of the people outside China, including Hong Kong. Meanwhile, I have been trained by Columbia, really changed my life. And I'm able to bring a lot of perspectives into that role. And generally speaking, from a personality perspective, I'm not afraid of picking up a fight, and when I need to, and that sometimes works. And I have a thick skin, so people, when during the trading hour extension, there are a lot of people really pissed off a lot of people. And I remember one demonstration in Hong Kong. They claim about 1,600 people. They actually put me into a Mussolini uniform, and I don't know why. And some people think I was sent by China Inc. to Hong Kong. I said I can never prove something that is not there.
Evan Pico, I work at Citi, and also an adjunct professor at Columbia. When you were speaking about enhancing risk management, I thought of derivatives, and so there's kind of a two-part question. One is in the States and in the EU, there's regulation that's pushing a lot of the OTC derivative market between market makers onto exchanges. So the first part of the question is, has Asian markets adopted that same kind of rule to push derivatives between large market makers onto exchanges? And if so, is that, since part of your business is not just a stock exchange but clearing, will your firm be involved in looking at the central clearing of derivatives?
Well, that's a great question, because ultimately at the exchange level, the most defensible, you want to be doing two things. One, you want to be in clearing. And it's the least sexy part. It's almost like a plumbing. And, and you don't hear about it, you don't know about it, but once it's there, nobody else should build it. And the money just is the money. I shouldn't be saying it's the money train. People think we're charging too much. But it is a very, very defensible business, extraordinarily high margin business, because once you finish building, and the operating leverage is massive. Second is derivative. Unlike equity, listing and trading, you can list it in your exchange, but everybody else can trade. In New York today, the trading volume, the actual trading volume is, if your company, for example, New York Stock Exchange or NASDAQ trades almost only 30% of the trading volume that of the company listed on their respective exchange. The rest are all traded by everybody else. High frequency trading, computer trading. In Hong Kong, in the U.S., there are 40 exchanges essentially, because some of them are two friends of mine just have a couple of machines in Chinatown, and they are actually counted as exchange because it's just machine trading, high frequency trading. So, but derivative is different. Derivative is the stock exchange issued contract. So when people start to trade, there's massive liquidity, and it's very sticky. It never goes away. So you want to be in the derivative business. That's why we want to move into commodities, move into fixed income currency. You want it to be in clearing. So I think this clearing, in particular, a lot of the OTC market, a lot of the cost. People say part of the cost of the financial crisis is that there's so much trading off the books over the OTC market that was so opaque. And so now part of the reform of the financial crisis is, number one, to standardize, anything standardized need to be traded on the exchange. And if you can't really trade it on the exchange, you need to clear it into a CCP. And so therefore, CCP become extraordinarily important, but it's also being regulated very toughly now. So it's a cutting both ways. So in Hong Kong, we are not yet, unlike in the US and Europe, you already have law mandating OTC contract to be cleared through a CCP. In Hong Kong, it's not mandatory yet. I think it would eventually become mandatory. But we anticipate this a long time ago. So about 3 years ago, we started to build OTC Clear. Almost a year into it, as soon as G20 meet, and there was a discussion that in the future, Hong Kong may need a CCP. Nobody wants to do it. And the people asked me, I was like 5 months into the job, I said, I want to do it. And because that's a strategic piece of assets. Because OTC Clear in Hong Kong does not work right away. Because most of the big banks trade either into the US or into the Hong Kong cleared there. Only the residual get cleared in Hong Kong. But when mandatory clearing comes, there will be more. But the reason we build OTC Clear is not because we want to fight LCH or DCTT. We basically think the renminbi future is massive, but it's not here yet. So when renminbi gets here, we're the first mover advantage. Nobody will be, we're small. We are not trying to really grab business from anybody else yet. We just focus on that narrow road, one way, and we're there, OTC Clear, and now that's all built. And as soon we spent about $300 million building it, Hong Kong dollar. And then I sold 25% of that, mark it up 4 times to the 12 banks, and because everybody see the big value of that. So we collected money back, 25% owned by the 12 funding members, and then they actually need to eventually put the trade through, will make money. So we have a strategic piece of assets that's almost free optionality for us.
I have a last question on behalf of my students. So many of our students at Columbia are interested in working in Asia and someday, and many in the audience have that interest. You have a tremendous record of success in your career. I wonder whether you'd be willing to share some advice with them and with members of the audience, what one needs to be doing to prepare for a successful career in Asia.
Yeah, I don't think it's fair for me to give advice on career, because if I had been competing with this kind of a crowd, I would never really got a job. So I think I happened to be entering into the industry at a time anybody who has a decent intelligence head on his shoulder, but is able to speak Chinese, probably get a pretty good job on Wall Street at the time, and because it's very few people. But today, just look at this quality, and there's another crowd in Harvard, there's another crowd in Stanford, and so it's difficult. So what I would simply say, simple issues, and do I go back? Do I stay? Do I get a job here? Do I try to get a job there? Obviously, circumstances are very, very different. But I would encourage people to think beyond the next job, the next opportunity right away. Try not to be as gongli in Chinese. I don't know the precise English. Not too practical. Practical is actually a positive word. And gongli is the negative word, but it's too practical. Okay, not getting too practical. But indeed, your biggest challenge, unlike my times, when I came here to study and to work, there's very little in China. So for us, it's a very easy decision. Anytime, anything, any job was perfect. It's better than going back. And there's actually no going back. When I left China, I told myself I would never ever go back. And I just we all had so much problem with in China at the time. So no opportunity cost. This crowd obviously going to have to deal with huge opportunity cost issues. If you stay here, what are the things you're losing? But I would actually think China is becoming so dynamic that unless you have something that you really, really passionate about, you really like, if you've been here for a while, obviously go back as soon as possible to make sure you are in the right position at the right time. But you've been there for a long time. This is your rare break of taking a year or two off to be at Columbia Business School, got a degree. Unless you got something exceptionally satisfactory, don't rule out, stay here a little bit longer, even if not the best job, because you learn something else that you won't be able to learn there. That is how a different culture works. Because here, there's still too many Chinese students. I would bet most of you stay together speaking Chinese all the time anyway, and go to Chinese restaurants like I am. And, trying to work in, unless you have something extraordinary, I would really encourage do something different, do something that gives you a very different perspective. Go to Kansas, work for a small broker, and go to some place. And maybe people there don't even know where China is. But you learn something else from them. And, because when you go back, whether or not you can have a year ahead of the next guy sometimes does not matter, because there's so many different things you could be doing. And if you don't like it, you could be changing into so many different directions. My time, when I was your age, I'm not that old, okay, but life is more linear. If you take this direction, that's where you're going. If you take that direction, that's where you're going. And it's pretty significant to divide if you make the wrong choice. Here today, it's just all over the place. You never know where you're going to end up with. So just do something. Don't do something that's just, sounds like something I should be doing. And don't do something because somebody else is doing it. Try not to call each other too much after graduation, because you're going to get depressed a little bit. All right? When you call somebody or when you take a call, make sure that guy is not doing as well. And then
on the high note, before I conclude the session and thank our speaker, I have one announcement and one small presentation. The announcement is after this formal session, we'll have a reception, and all of you are welcome to stay. And the small presentation is we have a presentation on behalf of Columbia Business School, a very small gift for our speaker.
Yes. Well, thank you. Thank you very much. Thank you. Thank you.